So one, I think that cycles can change shape over time. So
Hmm.
as we enter a more institutional phase, on average, I think we'll see a little bit less euphoria, but then potentially also a little bit less downward volatility, because you're not coming off of that level high of euphoria.
Hmm.
So when I look at metrics like market capitalization to on-chain cost basis, and so far we're nowhere near the peaks that we generally reached in say 2021, 2017, 2013, kind of those major multi-year tops. So this cycle has kind of been characterized by, pretty strong upward moves, and then maybe a 7 month consolidation, and then another significant upward move, and then another 7 month consolidation. I think that's a healthier market overall. Currently, we're in another consolidation. I wouldn't be surprised to see it continue for a couple more months.
The crypto market is evolving, but not in the way most people expect. Gone are the days of wild retail-driven euphoria and brutal capitulation. In their place, we're seeing something far more structural, a maturing institutional phase where the highs aren't as manic and the lows aren't as devastating. Yet despite this change in character, one thing remains constant: Bitcoin's ability to outperform in the face of macroeconomic pressure. Few analysts have captured the nuance of this shift as sharply as Lyn Alden, a macro strategist widely respected across institutional finance and the Bitcoin ecosystem alike. In her latest assessment, Alden makes a bold but measured claim: we are not at the top. In fact, this cycle hasn't even fully matured. By her metrics, particularly market cap to on-chain cost basis, we're still well below the peaks seen in prior cycles like 2013, 2017, or 2021. What we're experiencing now, she argues, is another period of sideways consolidation. And if history is any guide, these consolidation phases don't mark the end. They precede explosive upward moves. This thesis doesn't rest on hopium. Alden sees structural forces aligning in Bitcoin's favor. The US is operating under a regime of fiscal dominance, massive deficits, rising debt servicing costs, and a political unwillingness to cut entitlement spending. For traditional businesses, this creates headaches: margin compression, higher tariffs, input cost shocks. But for hard, non-yielding assets like Bitcoin and gold, it's a tailwind. These assets aren't exposed to input costs or price elasticity. They don't carry debt, and they thrive when fiat liabilities are being systematically devalued. Bitcoin, in Alden's view, is one of the fastest horses available at scale with liquidity. It's scarce, permissionless, and increasingly institutionalized. And unlike previous cycles, this one is marked by cleaner stair-step growth patterns, sharp rallies, multi-month consolidations, and then another leg higher. According to Alden, we're not just in the middle of one of these consolidations, we're nearing the point where the next leg could begin. In this video, we break down her full macro thesis, from structural deficits and fiscal dominance to why altcoin treasuries may be the biggest red flag yet. Make sure to like, subscribe, and leave a comment below with your thoughts, especially on whether you agree that this consolidation is just the calm before another breakout. Let's dive in.
Right. So the nothing stops this train thesis focuses a lot on the fiscal side, which I talked about, which is the U.S. is kind of locked into pretty high structural fiscal deficits going forward, especially on the spending side. And since that talk, the big beautiful bill has also kind of further locked in some of the things I've been talking about, which is, in any sort of investable time horizon, we're not meaningfully cutting Social Security, we're not meaningfully cutting Medicare or defense. Interest expense, even if we do get moderate short end Fed cuts over the next year, on average, interest expense is now, I think, structurally higher than what we got used to over the 2010s. And so overall, we're doing pretty significant deficit spending. It's only partially offset by the increased tariff revenue, which is again mostly coming out from Americans, either the consumer side or the businesses, or a blend of both, depending on what products in question. And so overall, that tends to run things pretty hot, at least. And that's where the breakdown is really important, because if you're on the receiving side of the deficits, it's pretty big stimulus. On the other hand, if you're not on the receiving side of the deficits, you're more facing the tighter monetary policy. You're more facing the tariff revenues. You're kind of, out of luck, more or less. So it becomes very sector specific. And generally speaking, gold and Bitcoin, the benefit is they don't have margins to worry about. They're not subject to the tariffs. They're not buying things at higher prices and then trying to figure out what percentage they can pass on to consumers in the way that American businesses generally find themselves in right now. And so I think we're past the worst parts of this cycle's liquidity crunch, which was 2022. I don't really see that happening in the horizon. I mean, eventually we'll have something like that again, most likely, but nothing's really on the horizon for a major liquidity crunch. And so I generally think that market conditions globally are going to continue to be conducive for Bitcoin. To some extent, gold. We got a little bit overheated. It was one of the most overbought we've seen on the monthly RSI, which is why I got somewhat near-term concerned around gold. But structurally speaking, looking out 3 to 5 years, I continue to be quite bullish on Bitcoin and gold. And Bitcoin, I tend to follow a little bit more cyclically, and I still don't think that this particular bull market is finished yet.
How far along are we in this current cycle?
So one, I think that cycles can change shape over time. So as we enter a more institutional phase, on average, I think we'll see a little bit less euphoria, but then potentially also a little bit less downward volatility because you're not coming off of that level high of euphoria. So when I look at metrics like market capitalization to on-chain cost basis, and so far we're nowhere near the peaks that we generally reached in, say, 2021, 2017, 2013. Kind of those major multi-year tops. So this cycle has kind of been characterized by, pretty strong upward moves, and then maybe a 7-month consolidation, and then another significant upward move, and then another 7-month consolidation. I think that's a healthier market overall. Currently, we're in another consolidation. I wouldn't be surprised to see it continue for a couple more months. I don't really have any strong view on near-term trading. Probably my recent orange flag or yellow flag was the rise of these altcoin treasury companies. That's kind of a sign of froth in the market. Combined with I previously mentioned maybe some of these economic deceleration risks over the next couple months. So I wouldn't expect to see a little bit more consolidation in the months ahead. But I do think we have probably at least another stair step up, like we've seen a couple of this cycle. Hopefully more than one. But I still think we're headed higher in terms of this kind of upward move and then consolidation and upward move consolidation. I still think we have more fuel this cycle.
Well, could Bitcoin be the only thing that moves along with this train, or do you have other assets in mind that could benefit from this shift in a paradigm here?
So I don't think it's the only thing. I think it's one of the fastest horses available at scale with liquidity. So structural bull on Bitcoin. But also, I mean, gold over bonds is generally a beneficiary of fiscal dominance. Equities at reasonable prices is also generally a beneficiary of these situation. I talked about strategy, formerly MicroStrategy. A company that holds Bitcoin, which is scarce, and then they issue various credit instruments denominated in the currency that's, we're running away in terms of fiscal dominance. So they put their liabilities in things that are debasing and their assets in terms of things that are scarce. And as long as they manage that conservatively through the various ups and downs and volatility cycles, they benefit. Even part of the reason why traditional equities can do well is because a lot of equities like locked in 5, 10, 20, 30-year bonds at super low rates, and bought back shares, and they still have a lot of those bonds outstanding. So their liability side is locked in and gradually getting inflated away, and the ones that have pricing power can keep ratcheting up their prices, and keep doing pretty well. So generally speaking, anything that has some degree of scarcity, whether it's an economic moat for a business or pricing power, or it's literal scarcity like gold or Bitcoin, is generally well positioned for fiscal dominance outside of kind of localized overbought bubbles that show up from time to time. And then anything that can attach a short of fiat currency to those things generally adds fuel to the fire as long as it doesn't get over its skis.
What sets Lyn Alden's Outlook apart is her ability to link long-term macro trends with actionable investment insight. Her "nothing stops this train" thesis has only grown more relevant over time. She points to the structural deficits baked into the U.S. fiscal framework, entitlement programs like Social Security and Medicare, defense spending, and now ballooning interest payments on federal debt. These are not temporary policies subject to election cycles. They are permanent features of the landscape. And even if the Federal Reserve manages to cut short-term rates modestly, Alden argues, the overall cost of debt servicing has entered a new regime, structurally higher and increasingly inescapable. That reality is inflationary by nature, and for monetary hedges like Bitcoin and gold, it's rocket fuel. That said, there are new headwinds entering the macro picture, and Alden is clear-eyed about them. Chief among these is the return of aggressive tariff policy, particularly under the leadership of President Trump in his second term. Despite recent efforts to frame tariff negotiations as deals or de-escalations, Alden points out that current tariff rates are still comparable to those that triggered market stress back in April. And yet, equity markets are brushing it off, pushing to all-time highs with narrow credit spreads and low concern. This disconnect, she argues, is dangerous. Many importers front-loaded purchases before the tariffs took effect, creating a temporary buffer that has delayed cost pass-through to consumers. But that window is closing fast. With over $150 billion in tariff revenue already flowing into U.S. coffers, the real burden, borne by American businesses and consumers, is only now beginning to materialize.
So my concern right now, for the next 2 months, I think we're in a vulnerable window where, like you said, we don't have all the information. There's a lot of uncertainty over the next couple months. And even the recent deals are still pretty high tariff rates compared to, pre-April. And so back in April, there were all these tariff proposals and the market freaked out. So equity sold off, credit markets freaked out, basically higher spreads. And right now, estimated forward tariff rates are pretty similar to what they were back in April before the de-escalation, and yet the market is at all-time highs. Credit spreads are narrow. There's really little concern, and so my general view is that there's more risk from tariffs than is probably being priced in, and so short of a major reversal, I do think that it'll be an ongoing friction against the U.S. economy, and then particularly tariff-heavy sectors. Most analysis so far, like when you look at import prices, they're not down, and they're measured pre-tariff. And so there's not much sign that foreign exporters are absorbing the cost, which means most of the tariff revenue is coming from some combination of American consumers and American businesses. There's also the fact that because tariffs were telegraphed in advance, many importers front ran the tariff. So they pulled in extra imports in quarter 1. And that gave them some degree of a buffer against, kind of the U.S. Treasury takes in, I think they reported over 150 billion in tariff revenue. Well, they also, because the importers pulled in a lot of products ahead of time, that gave them some buffer before they have to really kind of pass on costs to consumers. But as if the tariffs do stay in place as they are, I do think that'll increasingly trickle out to consumer prices. And so most of this is at least a mild drag on the U.S. economy that somewhat offsets other things that are stimulating. So we're still running pretty large structural fiscal deficits. Nothing stops this train. That's still the background situation. But then that is, at least around the margins, somewhat offset by these structurally higher tariffs. And most of the deals we see, like we saw the one with Japan, where, we place tariffs on them. Certain sectors are, more targeted than others. There's generally headlines around, say, big investments that Japan's going to do. But when you dig into the details, mostly it's lending, which in many cases they're already doing. That's generally how this mechanism works, is that the U.S. runs these really big trade deficits with the rest of the world. They take the dollars and then they often buy our assets, or deploy their credit into our assets. And so I expect that to continue. But basically, I think that we have this new kind of annualized multi-$100 billion tax that is roughly spread between American consumers and American businesses. Obviously, some sectors are more impacted than others. So we see, for example, Ford talking about the tariffs, but we don't really see Microsoft worried about the tariffs. And the reason that's notable is when you look at, say, the way these companies kind of operate Microsoft is something like 100 times the market cap of Ford. So when we're talking about investing, we're talking about the stock market, it's all about Microsoft. It's not about Ford. But when we look at the broader economy or socio-political situation, Microsoft doesn't even employ twice as many people as Ford does, despite being 100 times the market cap. And so things that slow them down or impair them, while they might not be as spectacular in the near term on the stock market, they do tend to trickle out quarter by quarter as we see some degree of stagnant economic conditions. So I'm currently in the camp that views gradually decelerating U.S. economic situation. We don't have great seasonality coming up, especially by September in the stock market. So I do think that at least this 2 month window is a time for potential caution until we have maybe a little bit more clarity on what tariffs are going to look like going forward.
How concerned should we be about tariffs?
I would say moderately, and more so economically than say the service sector stocks. Basically, this is where magnitudes are important. So basically, the fact that they brought in something like 150 billion in tariff revenue has to be compared with the fact that the U.S. is a $30 trillion economy, right? So while that's a non-trivial amount, it's not as though that's going to shut down the economy. In addition, some of that was buffered by the front running I mentioned, where companies were able to kind of pull in stuff ahead of time. So even as new purchases are coming with tariffs, they generally had inventory that they could still sell at prior prices. So I do expect to see some ongoing consumer price pressures from this. I'll be watching purchasing like import prices pretty closely to see to what extent, if any, foreign exporters are absorbing it. So far, not much. When we look at the recent GDP print, one of the things that complicates this is that tariff front running adds noise to the GDP figures. So if you remember, Q1 GDP was reported pretty weak. And that was negatively impacted by a lot of that import front running, because when you have a big uptick in imports, that puts downward pressure on GDP. And because we kind of have the hangover from that, where there's like less importing now, that's actually good for Q2 GDP. When you look at final domestic sales, the portion of GDP, that was markedly decelerating in Q2. It wasn't a catastrophic print, but it wasn't a very strong print. Also, if you look at CEO confidence, it's been down significantly recently, which is not great generally for CapEx and hiring. And so overall, I wouldn't say there's massive red flags in the economy, but there's certain yellow flags. I've generally been in the pretty bullish camp through 2023 and 2024. And here in 2025 is kind of the first time in a while that I do have more concerns overall around both the state of the U.S. economy and stock markets. But that's still in the picture of we're still running very large fiscal deficits, which for many industries are a stimulus. So generally what I do is I look at things industry by industry, and I'm trying to determine, is that industry in a recession? Is it priced for a recession? Versus other ones that might be at risk for a recession, but not priced for it. So I generally view sector by sector, industry by industry, rather than the whole economic picture.
As the U.S. economy enters a period of increased vulnerability, Lyn Alden's analysis serves as a crucial counterbalance to the complacency reflected in headline equity indices. Her warning is subtle but serious. While the broader market may appear healthy on the surface, the underlying fundamentals are shifting. Structural fiscal deficits remain, but now they're being offset, at least partially, by historically elevated tariffs that function as a stealth tax on consumption and production. This friction doesn't just challenge U.S. growth, it reshapes the playing field for capital allocation. In that new environment, assets that are both scarce and resilient, Bitcoin chief among them, stand to benefit not just from investor enthusiasm, but from a deep structural realignment. Alden's view is not driven by short-term price targets or speculation. She sees Bitcoin as an asset uniquely suited to fiscal dominance, a monetary system where government spending far exceeds tax revenue and traditional tools like rate hikes are increasingly impotent. Unlike equities, which rely on corporate earnings, or bonds, which depend on suppressed interest rates, Bitcoin's value proposition grows stronger as macroeconomic distortions deepen. And while she remains cautious in the short term, expecting a continuation of this consolidation phase. Her long-term conviction is clear. The cycle isn't over. In fact, the most powerful move may still be ahead. If you found Alden's analysis as compelling as we did, don't forget to like, subscribe, and comment below with your thoughts. Do you agree this cycle still has fuel left? Or are we heading into a macro wall? We'll be covering every step of this train, so stay tuned and thanks for watching.